If you are between 55 and 65 years old, the Canada Revenue Agency could be sitting on a $100,000 windfall that most financial advisors will tell you is too late for you to claim. Not a rebate you missed, not a program that already closed. Money the government has already set aside, waiting for you to ask for it correctly. You've probably heard about the Registered Disability Savings Plan, the RDSP, and its $90,000 in government grants and bonds. And you've probably heard the door on that program closes the day you turn 49. That part is true, but it's only half the story, and the half nobody repeats is worth far more than the part everyone does. The RDSP has an age limit. The Disability Tax Credit does not. If you live with a condition that slows you down day to day, arthritis, hearing loss, type 1 diabetes, and you never applied for that credit because someone told you the disability savings door was shut, you could be leaving up to $20,000 in retroactive tax refunds sitting with the CRA right now. That's real money attached to conditions a lot of people your age already live with quietly, without ever connecting it to a tax form. In the next few minutes, I'm going to walk you through the part of this system that bypasses the age 49 cutoff completely, and then show you 3 more programs you can stack on top of it. Put together, they add up to more than $100,000, even if you're convinced none of this applies to you. If you're getting close to retirement and you'd rather the CRA hand this money to you than quietly keep it, stick around and consider subscribing to the playbook so you don't miss what's coming. Here's the number that matters first. The Federal Disability Tax Credit for the 2025 tax year is worth $10,138. Claim it, and the federal government cuts your tax bill by $1,520.70 a year. Add your provincial credit on top, and most people see combined annual savings above $2,500. That's not a one-time check. That's money that comes off your taxes every single year you qualify. Compare that to the RDSP, the Registered Disability Savings Plan. It was built to match your savings while you still had decades left to let the account grow, which is why the government caps new grants and bonds after the year you turn 49. The Disability Tax Credit was built for a different reason entirely, to acknowledge the real cost of living with an impairment. And that cost doesn't disappear with age, so the credit has no cutoff at all. And that $2,500 a year is only the starting point. The CRA lets you go back and adjust your tax returns for up to 10 years. So if you qualified for this credit back in 2016 and never claimed it, you can still collect on every one of those years today in one application. This isn't a handout for people who can't work. It's a tax acknowledgement that certain conditions cost more to live with every single day, whether that's extra trips to the pharmacy, mobility aids, or hours spent managing a body that doesn't cooperate the way it used to. Do the math with me. $1,520 back from the federal government, plus close to $800 more from most provinces, comes to $2,320 a year. Multiply that by 10 years of retroactive claims, and you're looking at $23,200. One form, filed correctly, unlocking a number most people would call a windfall. But that 10-year window doesn't sit still. Every year that passes without filing is a year of that credit gone for good, dropping off the back end of the window, while a new one opens at the front. Most people who look into this stop the moment they hear the RDSP is closed to them. They never realize the T2221 form, the actual disability tax credit application, is a completely different door. It doesn't ask how old you are. It asks how your condition affects your daily life. I've seen people write off the entire disability tax system the day they turned 50 without ever checking whether the credit itself was still open to them. It was. But getting the CRA to say yes is only half the fight. The real gatekeeper on this form isn't a tax officer. it's your own family doctor, and how you talk to them about your health decides whether that $23,200 ever shows up. This is where most applications actually fail, and it has nothing to do with the CRA. It's the conversation you have in your doctor's office. Many family doctors hear the word disability and picture someone who can't work. That's not what this tax form is asking. The CRA's actual test is whether a condition markedly restricts a basic activity of daily living, walking, dressing, hearing, feeding yourself for at least 12 months. You can be fully employed, running a business, working full days, and still qualify. Disability and markedly restricted are two different conversations, and most doctors were never taught the difference between them. And every year that conversation doesn't happen is another year quietly falling out of the 10-year window we just talked about, gone before you even knew it was there. It's frustrating to sit across from a doctor who has watched you struggle with your knees or your hearing for years, and hear them hesitate because on paper you don't look disabled enough. That reaction is common, and it says more about how the form gets explained than about whether you actually qualify. The fix is how you frame the conversation. Don't lead with your diagnosis, lead with time. The CRA's real threshold is whether a task takes you an inordinate amount of time, generally understood as about 3 times longer than it would take someone without your condition. So instead of saying, "I have arthritis," you say, "It takes me nearly 3 times as long to get dressed most mornings, and some days I have to stop halfway through." Most doctors have spent years filling out forms for CPP disability or long-term insurance claims, and those forms really do ask whether you can still work. It's an easy habit to carry into a completely different form that's asking a completely different question. That mix-up trips more people up than any technicality buried in the tax code. I used to think this credit was only for people in wheelchairs. I was wrong. I've seen it approved for people managing a CPAP machine every night, and for people with severe irritable bowel syndrome, once they describe the time it actually costs them, not just the diagnosis on their chart. Once that form is approved, and the refund from the last decade lands in your account, a different worry usually shows up. If you're also receiving provincial disability support, does a sudden $20,000 deposit put those benefits at risk? That's worth answering before the money ever arrives. Before you get excited about a $23,200 check landing in your account, there's a real fear worth addressing directly. If you're also receiving provincial disability support, does a windfall that size put your benefits at risk? In Ontario, for example, the ODSP asset limit for a single person sits at $40,000. A retroactive refund that big can push some people close to that line. Here's the part that actually protects you. Under ODSP rules, an income tax refund counts as exempt income, meaning it doesn't reduce your monthly support payment the month it arrives. But once that money sits in your bank account, it becomes an asset. And that's a different test entirely. Leave the full lump sum parked in a regular checking account for months, and you could bump against that $40,000 ceiling. The way around this is straightforward. Move the refund somewhere the asset test doesn't reach. A registered disability savings plan is fully exempt regardless of the balance, and so is your principal residence and one vehicle. Some people also spend part of the refund on a documented disability-related expense, which ODSP treats differently from ordinary savings sitting in a bank account. Picture someone already sitting on $32,000 in savings while on ODSP, who then receives a $23,200 refund in one lump sum, deposited straight into a regular chequing account that pushes them to $55,200 well past the $40,000 ceiling. Moved into an RDSP instead, none of it counts against that limit at all, because the RDSP is one of the assets ODSP ignores completely. Same refund, same person, two very different outcomes depending on where it sits. None of this means the money isn't yours. It means where you park it. For a few months matters almost as much as receiving it in the first place. This is where I'd slow down and check your own province's rules before you spend $1 of that refund. Alberta's AIH program, Quebec's programs, and every other province set their own limits and their own exemptions. What protects you in Ontario won't automatically protect you in Fredericton or Calgary. A 5-minute call to your caseworker before the check arrives is worth more than guessing after it lands. Once that money is safely shielded, it's worth turning to the other $77,000 still sitting in CRA and government programs, the ones most people your age assume they've aged out of completely. Say you're 60, you own your home outright, and your kids are in their 20s. You've probably scrolled past every headline about the First Home Savings Account, the FHSA, and assumed it has nothing to do with you. You're right that you can't open one yourself once you already own a home, but you can still put its tax advantage to work, just not in your own name. Here's how. You can gift up to $8,000 a year in cash to an adult child, and they deposit it into their own FHSA. They get a tax deduction that lowers their taxable income for the year. The money grows completely tax-free inside the account, and when they use it to buy a first home, it comes out tax-free too. You never touch the account, you just supply the fuel. Picture two versions of that same $8,000. Leave it sitting in a regular GIC in your own name, and you pay tax on the interest every year, chipping away at a return that was already modest. Gift that same $8,000 into your child's FHSA instead, and it becomes a tax deduction for them this year, tax-free growth for as long as it sits there, and a completely tax-free withdrawal when they buy a home. Same dollars. Two very different outcomes, and only one of them has you paying tax on money you never even ended up spending yourself. The FHSA holds up to $40,000 over a lifetime. Pair it with the home buyer's plan, which now lets a first-time buyer pull up to $60,000 from their RRSP, and a couple buying together can put more than $150,000 toward a down payment using money that was already sitting in accounts, tax-sheltered the entire way. The government didn't design the FHSA with grandparents in mind. It built the account to help young adults save faster for a first home. But nothing in the rules says the cash inside has to come from the account holder's own paycheck. And that gap is exactly what makes the gift version work as well as it does. None of this requires you to have done anything differently 20 years ago. It just requires knowing the rule exists before your child signs a mortgage without it. Between the DTC refund and this FHSA strategy, we're already past $63,000 of the $100,000. The next piece is a program most people your age assume was only ever for young families. And it's sitting there unclaimed for thousands of Canadian kids right now. The Canada Learning Bond isn't new. It's been around since 2004, meant to help lower and modest income families start saving for their kids' education. What's newly relevant to you is how much of it is still sitting unclaimed. According to Employment and Social Development Canada, only about 40% of eligible children actually receive it. That happens because the money doesn't show up automatically. A family has to open a Registered Education Savings Plan, an RESP, and apply for the bond inside it. No contribution required from the parents at all. This is pure government money, but somebody still has to open the account and ask for it. Most families never do, usually because nobody told them it existed. The numbers are modest per child, but they add up. $500 lands in the account the first year a child qualifies, then $100 more for every additional year of eligibility, up to a maximum of $2,000 per child. And here's what most people don't realize. You can go back and claim it retroactively, right up until the child turns 21. I remember helping a neighbor realize her 19-year-old son was sitting on nearly $2,000 of what I'd call ghost money Government funds nobody had ever collected, simply because they'd never opened a no-fee RESP at their credit union. Most credit unions and several banks offer no-fee RESPs built specifically to receive this bond, with no minimum deposit required to open one. The paperwork takes about as long as opening a regular savings account, the kind of errand that gets put off for years simply because nobody ever flagged it as urgent. If you have grandchildren, or a son or daughter still in their late teens, this is worth 10 minutes of your time to check. Nobody at the bank is going to call and remind you. Add this to what we've already covered. $23,200 from the disability credit, $40,000 through the FHSA strategy, and up to $2,000 more here, and we're sitting around $65,000. To close the gap to $100,000, we need the last lever, and it's the one that quietly saves the most money of all, every single year you're retired. Here's the part almost nobody connects to their retirement income, even people who already have the disability tax credit. That $10,138 credit doesn't just reduce the tax on your regular income. It also lowers the tax on money you pull from your RRIF, your Registered Retirement Income Fund, every single year you're withdrawing. Think of it as raising the amount of income you can receive before the CRA starts taking a cut. A typical senior without the credit who withdraws $25,000 from their RRIF in a year pays tax on most of the income above roughly $16,000. Someone with the disability tax credit effectively shields an additional $10,000 or more of that same withdrawal from tax, because the credit wipes out what would otherwise be owed on it. Run that forward across a typical retirement. Shielding roughly $2,000 to $3,000 a year in tax on RRIF withdrawals doesn't sound dramatic on its own. Stretched across 10 to 15 years of retirement, it adds up to somewhere in the neighborhood of $35,000 that would otherwise have gone straight to the CRA. Skip this step, and you're not doing anything wrong exactly. You're just paying full tax on income the law already gives you a way to shelter. Nobody at the CRA is going to flag that you missed it. The credit only works if you claim it, and if whoever prepares your taxes actually applies it against your RRIF income, not just your regular paycheck income. A couple who are both eligible and both drawing down RRIFs can potentially double that shelter between them, which is worth raising directly with your tax preparer rather than assuming they've already applied it on your behalf. Add that $35,000 to what we've already covered: the DTC refund, the FHSA strategy, the learning bond, and you're at the $100,000 this video promised. If this breakdown showed you a path you didn't know was there, that's exactly why these videos get made, so hit subscribe before we close things out. Add it up one more time. The disability tax credit bypasses the RDSP's age 49 cutoff and can hand you $23,200 in retroactive refunds. The FHSA strategy turns money you gift your kids into $40,000 of tax-sheltered home savings. The Canada Learning Bond recovers up to $2,000 per grandchild sitting unclaimed. And using the DTC against your RRIF withdrawals saves roughly $35,000 more over a typical retirement. None of this arrives by mail. The CRA isn't going to call you and offer this back. The system rewards the people who understand how it works, not necessarily the people who need it most. That's not fair, and it's not new, but it is exactly why this video exists. This was never about being disabled enough, or needing help, or feeling uncomfortable saying either word out loud. It's about claiming credits the law already set aside for people exactly like you, whether you ever intended to use that word or not. None of these 4 programs require you to have planned perfectly years ago. They only require one phone call, one form, or one honest conversation with your doctor, whenever you're ready to make it a priority. I'm Brian, and this is the playbook. I'll see you in the next one.